All right, the last video I told you what truly causes inflation. It's not monetary printing machine. It's the government policy which leads to scarcity. Scarcity is what causes inflation for sure. It's always by the government policy. The government dictates confiscation of private property, a commitment or at least a concern of entrepreneurs and business owners that to invest is a risky proposition because they're not going to get rewarded for the risk they take. Which means they don't produce. This is what causes inflation, is scarcity. Now we're going to talk about deflation. All right, so let's go into this right here. So this is from my man John Malden, an advisor perspective, Dateline 5/28/2021. If you could ask the world's top central bankers what really terrifies them, the honest answer would be deflation. They think a little inflation is good, thus a 2% target, and they're confident they can subdue it. Deflation is a bigger problem. Let's note, however, these aren't either or conditions. They're not mutually exclusive. I could not agree more. That's why when I talk deflation, people say, well, what do you say about lumber prices? Like, it's a long-term march of deflation will still have temporary spikes in inflation in some products. That shouldn't shock, especially I can't argue with people like that because I'm like, oh my goodness. Can you not see with your own eyes how this is a short-term spike? Anyway, inflation and deflation have degrees of severity. In fact, the last 4 decades, we've seen disinflation, which is a mild form of deflation in many segments of the economy. All right. Dr. Lacey Hunt of Hoisington Management is a good perennial favorite of mine, says John Malden. He's been consistently right about inflation, little or none, interest rates, flat or down, and treasury bonds, bullish, for decades. He built that track record by simply standing his ground. To Lacey, it's all math. The equations have specific answers and thus do his investment choices. That may sound easy, but it does take courage. That's a fact. In Lacey's view, today's core problem is that excess debt suppresses economic growth, without which demand can't rise enough to generate inflation or even to push up interest rates over the medium term. This is a structural problem, which at this point can't really be fixed. Excess debt suppresses economic growth. Suppressed economic growth will not create demand to rise fast enough to generate higher inflation. And here, you can see the global debt as a percentage of GDP. 2002 is about 190. Now we're at 280. Isn't that nuts, man? The debt as a percentage of GDP. Now that you could attribute that to, look, we can have significant debt as a percentage of GDP without even increasing the debt if the GDP falls off a cliff. So I grant you that, but you can see it's been going up. Debt as a percentage of GDP, and even no one's going to argue that we're below 200% debt to GDP. No one would argue that. And the entire world. Going back further, he showed that U.S. experienced 5 major debt bubbles in the last 2 centuries, all of which led to not inflation but deflation. 1838, 1873, 1929 to 30, 2008. So we've seen debt bubbles. And we had disinflation in the latter part of the aughts. We had disinflation last year. And the average has been a 280%, 283% debt to GDP bubble. 2020 is at 407%. Nuts. He also pointed out inflation is actually a lagging indicator. It usually doesn't turn higher until well into a recovery phase. All right. This runs counter to today's popular narrative, which says to expect strong recovery and rising inflation at the same time. This guy said this doesn't happen. The typical lag between the start of a recession and the low point of inflation is almost 15 quarters. And even when the lags are shorter, only 6 to 7 quarters, in those particular 2 cases right here, Q4 2001, Q2 2009, the inflation rate was still near its low 2, 3, and even 4 years later. In fact, we can even say it's been a low inflation for the last 20 years. If you go into recovery or attempt to recover and inflation rate takes off, that will truncate the recovery. You'll have a wider trade deficit. Inflation will push up interest rates, and that will work against the recovery. And since prices rises faster than wages, you reduce real income. We talked about that in the last video. In other words, to have a major acceleration in inflation means the expansion will not hold. Dr. Lacey also explained why, or Hunt, Dr. Lacey Hunt, why he isn't worried about the increased monetary supply. It gets back to his point of view on debt. The amount of money is less important in which the speed it circulates, the velocity of money. So check this out. From 1918 to 1946, the velocity of money just dropped like a brick in water. Now, we can argue from 1930 to 1940, it went up. All right, I'll grant you that. But then they had the war, and then from 1950 to what? 1997. From 1950 to 1997, the velocity of money was going higher and higher and higher. Since then, kaboom. Isn't that crazy, man? Isn't that crazy? The velocity of money has dropped like a brick in water for the last 25 years. We had 40 years of the velocity of money increasing, and the previous 40 years, the velocity of money decreasing. Disinflation to deflation, or from the 1900s, basically through the beginning of World War II. A couple spikes of inflation for World War I, that's it. Deflation. All right, then after World War II, I mean, that was a party time. The party train was rolling on. The train kept rolling all night long. The train kept rolling all night long. Yardbirds did that. Aerosmith. I wonder if some black guy did that originally. The train kept rolling. I bet so. I bet John Lee Hooker, something like that. I don't know. But it'd be interesting to see. If you know who the originator of the song, The Train Kept Rolling, I'd like to know it. Put a link in the show notes if you would. All right, then we had huge velocity of money, which is everyone saying, oh, inflation historically has been 3%. Yeah, for these 40 years, but not, I mean, the last 25 it hasn't been. The 40 years previous that wasn't. I cannot stress this enough. At least 10 years ago, he and I were talking about what it'd take to get the velocity of money lower than during the Great Depression or post-World War II. We were both watching velocity slow significantly and as curious as when that would end. He explained, we have to take into account what's happening at the speed of money turns over and the velocity of money hitting an all-time low. And what is causing velocity to decline is that we're taking on too much debt. We're taking on too much debt is triggering diminishing returns and non-linear relationships, and this pulls the marginal revenue of product debt down and also takes a bank out of the process that pulls velocity lower. So this is pretty interesting. It's a tough graph to understand. But he believes that the debt reduces savings, and without savings and investment, you don't have growth. And he's kind of showing this in this chart right here. So basically, the critical variable for the macroeconomy is net national savings. And net national saving has three components. It has the gray shaded area, which is the private sector, right there, household and corporate, and then the government deficit, which is the red line. And green lines are some of the two. All right, so basically what's happening here, look at the little equation at the top of the page. All right, inflation, savings private, saving governor, saving not recession, saving government, saving of the top two. The one is the most important fundamental relations economics. It says essentially physical investment must equal saving out of income. That's what it is. Investment must equal savings. There you go. Investment must equal savings. Private sector, government sector, I guess deficits, I'm not sure what the R is. So investment must equal savings. And you can see the savings is dropping, and lower savings, lower investment, lower growth. If you not have saving out of income, you cannot get sustained growth and investment. Without sustained growth and investment, the standard of living does not rise. Now, the deficit as a percentage of national income was over 14%. Look at that, man. I mean, it's just crazy right here. 14%. They took out the percentage peak during World War II. The green line is the sum of the three, and you'll notice it's just barely above zero. Look at this. This is the net national savings right there. Oof. So you see, after World War II, big jumps. Well, here's the World War II. Then after the peace, you could drop because we had too much inflation. We got out of the war. Then we started ramping up production, and it just went off, and it's gone down ever since. Look at that. Went up until about 1965, slowly been going down ever since. Crazy. They took if you look at the chart, which goes back to 1929, you'll see there's only two situations that are worse during the 1930s and also during the late 2000s. We simply do not have the resources to fund ourselves and to attain a higher standard of living, which means the economy will falter as we go forward. Inflation will move lower. So right here, the real estate bubble, and right here, Great Depression. We are the lowest has been since then. I mean, isn't that crazy? Lacey is a rare PhD holding economist who doesn't hedge. President Truman once complained he wanted a one-handed economist because, on the other hand, he looks at this almost like physics. Gravity always wins. So when he says the economy will falter, inflation will move lower, he's confident in the same way astronomers are confident about planetary orbits. While something in theory could interfere, the odds are astronomically low. If I drop this thing of gum, it's going to hit the ground. Now, the only reason it wouldn't hit the ground is because something intervened, like me, grabbed it like that. But ultimately, it's going to hit the ground because I will die or something will happen, will hit the ground. It might take a little bit longer, but something will happen. This guy agrees that we could see some transitory inflation this year. He doesn't see it lasting long, and the Fed policy doesn't even matter. Here he is wrapping up my emphasis. If the Fed wanted to raise rates, they can slow the economic activity down. However, when economies become extremely over-indebted and debt levels are rising very dramatically, the velocity of money falls. And that keeps shifting the aggregate demand curve inward. So the demand is not expanding, it is going backwards because people are starting to hoard their cash because, like, what's going to happen in the economy? The fact of the matter is there is no mechanism other than for a limited period of time which the inflation rate can go higher. We have too much debt. The world has too much debt. Not just the U.S., the world has too much debt. And this guy's saying there is no mechanism other than a very limited period of time, supply side shocks, bottlenecks, scarcity created by government activity, in which inflation rate can go higher. In other words, as long as excess debt is pushing velocity lower, aggregate demand will continue to fall. Sustained broad inflation is impossible, though there could well be some temporary inflation. This guy says, I'd love to tell you why he's wrong. I can't, and many people have tried, and he's outlasted them all. Could not agree more. And then Kathy Wood on deflation. We got some other guy on deflation. David Rosenberg, which I kind of like that too. Core CPI, some of the other stuff in here. I'll put it on wages, growth. We hear about it. Just lots of good stuff in here. I like this one right here. Let's see. Right? Was it this one right here? He talked about U.S. core CPI and commodity prices. He had another one in here. Federal Reserve Bank of Atlanta average wage growth tracker, net and labor force zone, right here. Global ex-US core CPI going back to basically 1995. Look at that. Global price changes. There's nothing there, man. And you take that with Lacey Hunt's thing about global debt, and you can see why. Too much debt, man. Too much debt. Too much debt is, we've consumed in the past what we should be consuming now, but the reason being because we took on debt to buy it, your new car. I'll show you the comment I made here. And if you like Kathy Wood, she says something. Let's see if they posted my comment or if anyone responded. Yeah, so the problem is what with the monetarist take on inflation, too much money chasing too few goods, is they only focus on too much money. But it turns out it's the too few goods side that actually dominates. Supply chain bottlenecks have led to short-term goods deficits, but once that's rectified, we're right back to the march of deflation. Couldn't agree more with that guy. Oh, because that was me. Hey, I'd love to hear your thoughts. Let me know. Thanks now.